Hi class, this video is the final in a series of videos that explains how we account for inventory using the Year 11 accounting course. And this video is going to focus on how we record inventory losses and gains. So we've gone through a number of things in this series of videos to help you understand how a small business accounts for inventory. And this video assumes that you understand what a physical stock take is and also a perpetual inventory system where we record the movement of inventory coming in or out of our business. Because this video is going to solely focus on how we record things in inventory cards and particularly inventory gains and losses. So what is an inventory loss or gain? Let's think all the way back to physical stock takes or inventory counts and what they are. Remember, minimum once a year, generally on the reporting date, a physical stock take is completed. This is when a physical person goes around and counts the number of units of inventory on hand for every type of inventory a business sells. So they have a count of how much each good does the business have on hand. Now remember, we've been recording inventory coming in and out of our business using inventory cards. So this number is then compared to the number of units on the inventory card. And there are three possible outcomes that could occur when this is done. Firstly, the number of units counted is the same as the inventory card. Relatively rare in this course, but if that happens, no action is required. Our cards are accurate. We might do a count where the number of units counted is less than shown on the inventory card. Now, if we think this through, we have to make an assumption. We need to adjust one because there are differences. But what is more accurate? The count that we've just done or the cards we've been recording? The assumption, and it is a valid assumption, is that the count is more accurate. It's taken a lot of effort. We've done it very recently. That's the most accurate. So we would say if the count shows less than what's on the card, we have an inventory loss. And the inventory card needs to be adjusted to show the loss. Conversely, we might do a count and the number of units counted is greater than that shown on an inventory card. In this case, an inventory gain has occurred and the inventory card will be adjusted to show the gain. So, quick summary again, checking cards to the count, the stock take, can lead to the following. The count reveals an amount of inventory less than the card. The count shows a number less than what our card says. And we have what we call an inventory loss. The count can reveal a number that is higher than what is on the cards, and that equals a gain. But how has this happened? What are some of the reasons that we could lead to an inventory loss or gain? So an inventory loss might occur due to a number of reasons. This is because we have less than what we thought we did. So this could occur due to undersupply by suppliers, customers giving less than what we thought. Oversupply to customers, we give more to our customers than what we recorded. A common one is theft, they've been stolen. We've made errors on our cards. We might have done duplicate invoices by suppliers, so we've recorded things by suppliers too many times, or we could have just made other errors. There are less reasons for an inventory gain where we find we have more than what we thought. This could be oversupply by our suppliers. Suppliers have given us more than what we thought. Undersupply to customers. We've accidentally given our customers not enough. And again, the same errors that we could potentially have done to lead to an inventory loss, just putting the wrong numbers in. This is a good time to update your notes to understand why we might have an inventory loss or gain. But how do we record an inventory loss? The number in our count being less than what we thought. The stock take has revealed inventory on hand is less than the inventory cards. Before we do this, we need to understand that this inventory loss is going to be classified as an expense. Where do expenses get reported? In our income statement, and they impact profit. So this identification of a loss is going to reduce our profit. Why? Because it meets the definition of an expense. It represents an outflow of economic benefit, inventory, we've lost some inventory. This outflow is in the form of a decrease in assets. Our asset inventory is going down. And this is going to lead to a decrease in our owner's equity, the worth of our business. We've lost something that will make our business worthless. So let's have a look at a question. May 31, we've done a stock take and it reveals there are 5 hammers in inventory. And if we look at our inventory card, how many do we think we have by the end of the month? The only last transaction was May 3rd, and we think we have 8 left. 1 worth 10, 7 worth 12. What ones do we, so we think we have 8, we know we have 5, so which one is going to be removed? We have to reduce this inventory by 3, which is going to go in our out column. But do we remove the $10 one, the $12 ones? How do we work this out? We need to have a rule. When recording an inventory loss, we make an assumption that FIFO is applied. This means the earliest, oldest inventory will be assumed to be lost. Regardless of whether you're doing an identified cost or FIFO inventory card, you always assume FIFO. So what was our oldest stock here? The $10 one. So we're going to make an assumption using a memo. This will always be recorded in a memo. That one of the $10 ones will be lost because that is our oldest stock. We haven't got down to 5 yet. We still then need to record 2 of the $12 ones. And that means we then have 5 $12 ones left, or $60 worth of inventory. And that's how you record an inventory loss. A few things to remember. It goes in your out column. It is an expense. And we use FIFO, so oldest stock is assumed to be lost. And that tends to make sense as an assumption. Inventory being lost, the older stock has had more chance to be lost, stolen, those sorts of things. Inventory gains reveal that the stock on hand is more than the sum of the inventory card. There is an error in that. It should say more. And we make an assumption then, if inventory losses were expenses, inventory gains hence must be revenue, a good thing that increases profit. And this is because, again, it meets the definition of revenue. It is an inflow of economic benefit in the form of an increase in assets. Our inventory is going up. And this inventory going up is going to lead to an increase in owner's equity. Our profit is going to go up. So let's have a look. Instead of thinking there was 5, we actually do another stock take and it reveals there was 9. Same stock inventory card, but this time we think we have 8, but we discover we have 9. Which one do we assume, what cost price do we assume has been found? We again have a rule. When recording inventory gain, the unit should be recorded at the latest purchase price. So what was the latest purchase price that we bought our goods for? That is our assumption. And if we look at the in column, there's only been one purchase, and that was 10 units, 10 hammers at $12. So that's our latest purchase price. So we make the assumption in the in column, because inventory is going up, that one of the $12 ones isn't the increase. So we still have one $10 hammer, but we now have 8 $12 hammers. So again, let's think this through. What's to remember? Inventory gain, we have more than what it says on our inventory cards. This is revenue. It gets recorded in the in column, and we use the cost price. That was the last purchase. And these are the things to remember. So in summary, that is the final video in our series of videos of how we record and understand how small businesses account for inventory. Hopefully this video you have developed an understanding of an inventory gain and loss and feel confident to record them in your inventory cards following the rules of accounting.